Burton Malkiel's A Random Walk Down Wall Street.
Oh yeah, a truly timeless guide to investing.
It is.
First published almost 50 years ago.
Hmm.
It's been updated and updated and updated again. And Malkiel's really unique. Your perspective as an academic, a market professional, and an investment committee chair makes it a must-read for anyone looking to navigate the world of finance.
Okay, so let's get right to the heart of it. What's the one big idea that Malkiel really wants us to walk away with?
Well, he makes a really compelling case that for most investors, trying to beat the market is a fool's errand. Instead of chasing those hot tips or trying to time the market, Malkiel suggests that buying and holding a broad stock market index fund is likely to yield better returns over the long run.
You know, that's interesting because you always hear stories about people who made a killing picking the right stock at the right time.
Right. It's tempting to think we can all be stock-picking geniuses.
Yeah.
But Malkiel dives deep into the psychology of investing, and he introduces this castle in the air theory,
Okay.
which basically says that stock prices are often driven by speculation and emotions rather than a company's true intrinsic value.
So it's like those times when everyone gets caught up in the hype, prices go crazy, and then the bubble bursts, like the dot-com bubble or even the recent meme stock frenzy.
Exactly. Malkiel uses historical examples like tulip mania in the 17th century in Holland, where people were literally trading their houses for tulip bulbs,
Wow.
only to see the market crash and lose everything.
Wow. That's a pretty extreme example. It makes you wonder what drives people to make those kinds of decisions.
Well, Malkiel argues that it's human nature to get swept up in the excitement of the market. We tend to be overconfident in our abilities, and we're easily influenced by this herd mentality. We see others making money, and we want to get in on the action too.
I can definitely relate to that.
Absolutely.
It's easy to get caught up in that fear of missing out.
Right. And Malkiel also points to the role of market gurus and financial media, who often promote this idea that anyone can beat the market if they just have the right strategy or follow the right advice.
But his research shows that even professional investors, with all their resources and expertise, struggle to consistently outperform the market.
Right. The data simply doesn't support the idea that active stock picking leads to superior returns, especially after you factor in those costs of trading and management fees.
So if I'm hearing you correctly, Malkiel is saying that instead of trying to be smarter than the market, I should just accept that it's essentially a random walk and focus on a strategy that minimizes risk and maximizes returns over the long term.
That's the essence of his argument. He's not saying that you can't ever beat the market, but the odds are stacked against you.
Yeah.
Especially for the average investor with limited time and resources.
It's kind of liberating in a way to let go of the pressure of trying to pick the next big winner and just focus on building a solid, diversified portfolio.
I think that's one of the most valuable takeaways from Malkiel's book. He challenges our assumptions about how the market works and encourages us to adopt a more rational and disciplined approach to investing.
That makes sense.
Yeah.
So if I'm not trying to pick individual stocks, how do I go about building this diversified portfolio that Malkiel recommends?
He's a big advocate for index funds, which basically track a specific market index like the S&P 500. Instead of trying to pick winners and losers, you're essentially buying a slice of the entire market.
Okay. But how does that help me achieve my investment goals?
Index funds offer a number of advantages. They provide instant diversification because you're investing in hundreds or even thousands of companies at once.
Oh, wow.
They have lower fees than actively managed funds, and historically, they've performed as well or better than most actively managed funds over the long term.
That's a pretty compelling case for index funds. But I'm also thinking about risk. I mean, we've talked about market crashes and bubbles. How can I protect my investments from those kinds of events?
Right. That's where Malkiel's emphasis on asset allocation comes in. It's not just about stocks. You want to consider other asset classes like bonds, real estate, and even international investments.
So it's like that old saying, don't put all your eggs in one basket.
Exactly. Spreading your investments across different asset classes can help you weather those market storms and reduce your overall risk.
Okay, I'm starting to get a clearer picture of what a well-rounded portfolio might look like. But it still feels a bit daunting to think about managing all of these different investments.
One of the key insights from Malkiel's book is that investing doesn't have to be complicated. He encourages us to focus on the fundamentals and adopt a long-term perspective.
So instead of constantly checking my portfolio and reacting to every market fluctuation, I should be thinking about my overall financial goals and how my investments are aligned with those goals.
That's a great way to put it. Investing is not about getting rich quick. It's about making smart, informed decisions that will help you build wealth over time.
This is all really helpful. But I'm curious, what are some practical steps I can take to start putting Malkiel's principles into action?
A great first step is to assess your current financial situation.
Oh.
Where are you now, and where do you want to be in the future? Once you have a clear understanding of your goals, you can start to develop an investment plan that's tailored to your individual needs and risk tolerance.
It sounds like Malkiel is advocating for a more mindful approach to investing, rather than just blindly following the herd or chasing the latest trends.
That's a great way to sum it up. He challenges us to think critically about our investment decisions and to be aware of the psychological biases that can influence our behavior in the market.
This has been a really eye-opening conversation. I'm starting to feel a lot more confident about navigating the world of investing.
I'm glad to hear that. Remember, investing is a journey, not a destination. There will always be ups and downs, but with the right knowledge and a disciplined approach, you can set yourself up for success.
That's encouraging. So I'm starting to understand the why behind Malkiel's investment philosophy, but I'm also curious about the how. What are some specific strategies that he recommends for actually managing my portfolio?
Well, one strategy that Malkiel emphasizes is dollar cost averaging. Have you heard that before?
I think so, but I'd love to hear more about how it works.
Okay. It's a simple but powerful concept. Instead of trying to time the market, you invest a fixed amount of money at regular intervals. This helps to reduce the risk of buying high and selling low because you're spreading your purchases over time.
So even if the market is volatile, I'm still consistently investing, which takes some of the emotion out of the equation.
Exactly. It's a disciplined approach that can help you stay the course even when the market is going through a rough patch.
I've definitely been guilty of letting my emotions get the best of me in the past, especially when it comes to investing.
Right. Well, Malkiel addresses that too. He talks about the importance of controlling your emotions and not letting fear or greed dictate your decisions.
So it's really about having a plan, sticking to it, and not getting swayed by the latest headlines or market rumors.
Exactly. It's about being a rational investor, not an emotional one.
This is making a lot of sense. What are some other strategies that Malkiel recommends for managing my portfolio?
Another key concept is rebalancing. This involves periodically adjusting your asset allocation to make sure it still aligns with your investment goals and risk tolerance.
Can you give me an example of what that might look like in practice?
Sure. Let's say you start with a portfolio that's 60% stocks and 40% bonds. If the stock market has a strong run, your portfolio might end up being 70% stocks and 30% bonds. To rebalance, you would sell some of your stocks and buy more bonds to get back to your target allocation.
So it's about maintaining a balance between different asset classes and not letting one asset class dominate your portfolio.
Exactly. Rebalancing helps to ensure that you're not taking on more risk than you're comfortable with, and it can also help you to buy low and sell high.
This is all incredibly helpful. I feel like I'm starting to get a real grasp of how to build and manage a portfolio that's aligned with my goals.
That's great to hear. And remember, it's an ongoing process. You'll need to revisit your portfolio periodically and make adjustments as your circumstances change or as the market evolves.
This has been a really insightful deep dive into Malkiel's A Random Walk Down Wall Street. I feel like I've gained a whole new perspective on investing.
I'm glad to hear it. It's a book that can truly change the way you think about money and the markets.
I'm definitely going to pick up a copy and dive deeper into Malkiel's ideas.
I highly recommend it. It's a classic for a reason.
Well, I think we've covered a lot of ground in this first part of our deep dive, but there's still so much more to explore.
That's right. We'll be back soon to delve deeper into some of the more nuanced aspects of Malkiel's investment philosophy.
Okay, so we've laid a solid foundation with those core ideas from Malkiel.
Right.
What I'm really curious about now is how to actually put those principles into practice. Where should I even start?
Well, let's dive into some specific asset classes and unpack Malkiel's take on each one. Starting with bonds.
Okay.
One thing he stresses is understanding this concept called duration.
I've heard that term before, but I'm not entirely sure how it applies to bonds.
Yeah, so think of duration as a way to gauge how sensitive a bond's price is to interest rate changes. A longer duration means the price will swing more dramatically when interest rates move.
So if interest rates rise, a bond with a longer duration would lose more value compared to a bond with a shorter duration.
You got it. That's why duration is so important when assessing the potential risk in a bond investment.
That makes sense. So if I'm worried about rising interest rates, I should be looking for bonds with shorter durations. But picking individual bonds seems pretty complex. Are there index funds for bonds too?
Absolutely. Bond index funds have become super popular. They give you that same diversification and low-cost advantage as stock index funds, but with a focus on bonds.
So if I want a simplified way to get into bonds, a bond index fund could be a good option.
It can be. You're essentially riding the performance of the bond market as a whole without the headache of picking individual bonds. Now, Malkiel highlights that while bonds provide stability and income, they can be vulnerable to inflation. Right? Inflation eats away at purchasing power, and bonds typically pay a fixed interest rate. That's something to keep in mind. What about real estate? It seems like everyone's talking about real estate investing these days.
Malkiel acknowledges that real estate can be an attractive investment,
Yeah.
but he emphasizes the importance of understanding those local market dynamics.
Okay.
What's happening in New York City real estate is a different beast than, say, a rural area in the Midwest.
I can see that.
Yeah.
So before diving into real estate, it's crucial to research what's driving the market in that specific location. But what about REITs? We touched on them earlier as a way to invest in real estate without actually owning property.
REITs can be a good addition to a diversified portfolio, but Malkiel points out that REIT prices can also get inflated, just like any other investment. It's not a magic bullet.
So due diligence is still key even with REITs. What factors should I be considering when evaluating them?
Look closely at the properties they hold. Are they in markets with good growth potential?
Also assess the management team's track record and scrutinize their financials to ensure they're in good shape and generating consistent income.
That aligns with Malkiel's emphasis on looking beyond past performance and really understanding what you're investing in.
Exactly. It applies across the board, whether it's a stock, a bond, a REIT, or anything else. Due diligence is paramount.
Got it. Now, I know Malkiel has some strong opinions about staying away from certain types of investments. What are those?
He's quite skeptical of gold and commodities as long-term investments.
Mm-hmm.
He argues that gold, for instance, doesn't generate any income and can be expensive to store and insure.
So buying gold bars and stashing them under my mattress isn't the foolproof plan I thought it was?
Well, while gold can act as a hedge against inflation in certain situations, Malkiel believes there are more effective strategies for protecting your portfolio.
Okay, so gold's off the table.
Yeah.
What about commodities like oil or coffee beans?
Commodities can be extremely volatile. Their prices are influenced by unpredictable factors like weather events, geopolitical situations, and global supply and demand fluctuations.
Sounds risky.
It can be. Malkiel suggests commodities are more suitable for short-term speculation than long-term investment strategies.
Okay, sticking to those fundamentals and avoiding speculative bets makes sense. But I'm curious about mutual funds. Malkiel seems particularly concerned about fees in this area. What should I be watching out for when choosing a mutual fund?
He's adamant about avoiding funds with high expense ratios.
Oh.
Those fees can eat into your returns over time, so lower expenses are always better. You want your money working for you, not lining the pockets of the fund managers.
Lower expenses? Check. What else should I be aware of?
Be wary of sales charges or loads when buying mutual funds.
Okay.
These are upfront fees you pay when you purchase the fund, and they can be quite significant. Opt for no-load funds whenever possible, so more of your money goes directly into the investments.
No load funds noted. And what about those 12B1 fees I've heard mentioned?
Oh, those are annual fees. Some funds charge to cover marketing and distribution costs. They might seem small, but they can add up, so it's worth seeking out funds without them.
Got it. It's all starting to add up. Lower expenses, no loads, and no 12B1 fees mean more money working for me in the long run.
Precisely. And one more thing Malkiel cautions against is excessive trading or churning by fund managers.
Okay.
This constant buying and selling can generate transaction costs and taxes that eat into your returns.
So it's like they're playing a game with my money, but I'm the one who ends up losing.
It can feel that way. Look for funds with lower turnover rates, indicating they're not trading frequently. This often suggests a more patient and disciplined approach to investing.
Lower turnover, check. Anything else to keep in mind when it comes to evaluating mutual funds?
Don't get blinded by past performance. A fund that did well previously doesn't guarantee future success.
Right.
Consider other factors like the fund's investment strategy, its risk level, the expense ratio, and the quality of its management team.
Okay, so due diligence is key, even with seemingly straightforward investments like mutual funds. Don't be swayed by flashy marketing or promises of high returns, but really understand what I'm investing in.
Exactly. It all comes back to making informed decisions that support your financial goals.
This has been incredibly helpful. I'm starting to feel much more confident about navigating the world of mutual funds.
That's great to hear. Malkiel's insights provide a roadmap for making smart choices and avoiding common pitfalls.
Okay. What other areas of investing should we explore? Does Malkiel delve into any specific investment strategies beyond index funds?
He does. One interesting strategy he highlights is called the Malkiel step, which involves buying closed-end investment company shares at a discount from their net asset value, or NAV.
Closed-end funds. I'm not too familiar with those. Are they different from the open-end mutual funds we've been discussing?
You're right, they are different. Closed-end funds have a fixed number of shares that trade on stock exchanges, just like any other stock. Open-end funds, on the other hand, can issue and redeem shares on demand.
So with closed-end funds, you're buying and selling shares in the fund itself, rather than directly buying and selling the underlying assets.
Precisely, and sometimes these funds trade at a price that's lower than the actual value of their holdings. Malkiel believes savvy investors can potentially benefit from these discounts.
So it's like finding a bargain, buying something for less than it's truly worth.
In a way, yes. But like any investment, there are risks involved. Those discounts can persist for a while, and sometimes they even widen.
Okay, so it's not a guaranteed win.
Yeah.
What else should I be aware of with this Malkiel step strategy?
Malkiel emphasizes the importance of research. It's not enough to just see a discount. You need to understand why it exists. Look at the fund's management quality, investment strategy, and overall financial health.
So once again, due diligence is key.
Yeah.
Don't just blindly buy a discounted fund without understanding what's behind that discount.
Exactly. Thorough analysis and a clear understanding of the fundamentals are essential.
Now, we've talked a lot about Malkiel's advocacy for index funds, but I'm curious about other investing approaches. Does he discuss any alternatives in his book?
He does. One he talks about is value investing. This approach focuses on identifying undervalued companies that the market has overlooked.
So it's kind of the opposite of chasing those high-flying growth stocks everyone talks about. Value investing is more about finding those hidden gems that are trading at a bargain.
That's the general idea. Value investors look for companies with strong fundamentals, low price-to-earnings ratios, high dividend yields, and solid balance sheets, but whose stock prices haven't yet reflected their true worth.
It sounds intriguing. What are some key things to keep in mind with value investing?
Malkiel points out that it can be a very successful strategy, but it takes patience and discipline.
Okay.
Value stocks don't always perform well in the short term. It often takes time for the market to recognize their true value.
Okay, another strategy where a long-term perspective is critical. It seems like that's a recurring theme in Malkiel's philosophy.
It is. He consistently emphasizes the importance of taking a long-term approach to investing and not getting caught up in short-term market fluctuations.
Now, I know Malkiel isn't a fan of market timing, trying to predict when the market will go up or down, but does he offer any guidance on when it might be a good time to buy or sell stocks?
He does offer some general advice.
Okay.
He suggests considering increasing your stock allocation when market valuations are low, like during a bear market, and selling when valuations are high, like during a bull market.
So it's about going against the herd, buying when everyone else is fearful and selling when everyone else is greedy.
Essentially, yes. But it takes courage and a strong contrarian mindset to implement such a strategy.
I can see that. It's easy to get swept up in the emotions of the market, but it sounds like Malkiel is advocating for a more rational and disciplined approach.
Absolutely. He encourages investors to stick to their investment plans and not be swayed by short-term market noise or the latest headlines.
Okay. One last question before we wrap up this part of our deep dive. Does Malkiel have any final words of wisdom for investors like me who are just starting out on this journey?
He reminds us that investing is ultimately about achieving our financial goals, whether it's saving for retirement, buying a house, or anything else. He encourages us to make informed decisions that support our individual circumstances and long-term objectives.
That's a great reminder. Investing shouldn't be about gambling or trying to get rich quick. It's about making smart choices that will help us build a secure financial future.
Exactly. And remember, it's an ongoing process of learning and growth. The more you understand about investing, the more confident you'll be in making those choices.
Well, I feel like I've already learned so much from this deep dive into Malkiel's A Random Walk Down Wall Street.
I'm glad to hear that. And remember, this is just a taste of what his book has to offer. I highly recommend picking up a copy and diving deeper into his insights.
I definitely will. And for all of you listening, we'll be back soon with the final part of our deep dive. We'll explore some of Malkiel's more provocative ideas and unpack the implications of his investment philosophy for the future. Okay, so we're back for the final part of our deep dive into A Random Walk Down Wall Street. I feel like we've covered so much ground already. But, you know, there's always more to learn. I'm eager to hear what other insights Malkiel has in store for us.
We know there's one point he makes that really stuck with me. It's about the 1987 stock market crash, which was a pretty dramatic event.
It was.
Even after witnessing such a steep drop, Malkiel doesn't completely abandon the efficient market theory.
That's interesting because you'd think a crash of that magnitude would shake anyone's belief in market efficiency.
Right. It's tempting to see it as proof that markets can behave irrationally. But Malkiel argues that while we may never fully grasp what triggered the crash, it doesn't necessarily invalidate the idea that markets are generally efficient.
So how does he explain such a dramatic event if markets are supposed to be efficient?
He points to several factors, like program trading, which was still relatively new back then, and portfolio insurance strategies that backfired. He also acknowledges the role of investor psychology. Fear and panic can spread quickly, leading to a cascade of selling.
That makes sense. It's like a self-fulfilling prophecy. When everyone starts selling, it pushes prices down further, fueling even more fear and selling.
Exactly. Malkiel suggests that even in an efficient market, there can be periods of extreme volatility driven by various factors, including investor behavior.
So this brings up a question for me. If markets can be efficient and yet still experience these dramatic crashes, how can I feel confident about investing my money?
Yeah, that's a valid concern, and it gets to the heart of the matter. I think the key takeaway is that while markets are generally efficient, they're not perfect. There will always be risks and uncertainties.
So what can I do to navigate those risks and protect my investments?
Well, we've touched on many of these strategies already. Diversification is essential. Don't put all your eggs in one basket. A long-term perspective is crucial. Don't panic and sell when the market takes a dip. And finally, don't invest more than you can afford to lose.
Those are all good points. It's easy to get caught up in the excitement or the fear of the moment, but I need to stay focused on my long-term goals.
Precisely. Investing should be about making informed decisions that align with your financial objectives, not about emotional reactions to market swings.
Well, I'm feeling a lot more equipped to handle those ups and downs now. Is there anything else from Malkiel's book that stands out to you as particularly helpful for investors like me?
One more point I think is worth emphasizing. He stresses the importance of staying true to your investment strategy even when things get tough.
Can you elaborate on that?
Sure, markets go up and down. It's inevitable. There will be times when your investments are doing well and times when they're not. It's easy to get discouraged when the market takes a downturn, but it's crucial to remember that these fluctuations are normal.
So basically, ride out the storm and don't abandon ship at the first sign of trouble.
Exactly. If you've done your research and you believe in your investment strategy, stick with it. Trying to time the market or chasing the latest hot stocks rarely ends well.
It makes sense. It's about being disciplined and patient. Focusing on the long game rather than getting sidetracked by short-term noise.
That's it in a nutshell. Malkiel encourages us to be rational investors, not emotional reactors.
I feel like I have a much better grasp on how to do that now, thanks to this deep dive.
I'm happy to hear that. Remember, investing is a journey. There's always more to learn and experience, but with a solid understanding of the fundamentals and a commitment to lifelong learning, you can navigate the markets with confidence.
Well, I'm feeling much more confident about my investing journey now. Thank you for sharing your insights and guiding me through Malkiel's random walk. It's been a fascinating journey.
It's been my pleasure. I'm always excited to share knowledge and help others demystify the world of investing.
And for everyone listening, I hope this deep dive has given you a fresh perspective on investing. If you're looking to level up your understanding of the markets, A Random Walk Down Wall Street by Burton Malkiel is a must-read. It's a classic for a reason.
Absolutely. It's packed with timeless wisdom that can guide you on your path to financial success.
And be sure to join us next time when we'll be exploring another investment classic. Peter Lynch's One Up on Wall Street. We'll be diving deep into Lynch's strategies for identifying winning stocks and gaining an edge in the market. It's going to be great.
It's going to be another fascinating conversation. We can't wait to share it with you.
And if you enjoyed this episode, please do us a favor and like, subscribe, and share it with your friends. It really helps others discover our show and join our community of lifelong learners. Happy learning.